Hi, this is Randy Finney with Right Side of the Chart, and today is Sunday, September 11th, 2016. It is the 15-year anniversary of the September 11th attacks. A lot of innocent and good people lost their lives during those attacks, and I just want to say that, my thoughts and prayers will always be with you, and you'll never be forgotten. Let's go ahead and jump into the charts. And what I want to do in this video is we'll start out just looking at Friday's price action, what happened on Friday, especially for those of you that might not work full-time jobs or don't trade in and out. If you trade actively, you're probably watching the price action throughout the day. And I know a lot of people don't have full-time jobs or whatever, so by now you've probably come home and heard the headlines. Friday we had a pretty ugly day in the market. And so we'll go over what happened, and then I'll roll into some near-term targets for the market, some key support and resistance levels to keep an eye on, and then we'll roll into some of the longer-term scenarios, both bullish and bearish. I always say one day does not make a trend. So, the markets were down, as we can see here, at least QQQ, the NASDAQ 100 tracking ETF, down by about 2.5%. Certainly the worst day in a couple months, but by all means, not not one of those crazy 4 or 5% down days that market can have. We weren't anywhere close to having circuit breakers kick in. So, it seems very ugly. And I do think, let me be very clear, it was very technically significant. And I'll get into that. Before I do, I want to digress for 1 second. As I mentioned, a lot of you may not be full-time traders. You may follow the site periodically. You may be new to Right Side of the Chart and come across this video somewhere else. If that's the case, a couple things that I'll do. I won't go over everything that I've covered for months, although that does very much play into what happened today as well as where we may be heading. So what I would recommend is a couple ways to catch up on the market analysis on Right Side of the Chart. If you come into the home page, you can type the short URL rsotc.com. It'll take you to rightsideofthechart.com. And if you hover on this market analysis category in the main menu, you can see the subcategories: gold, fixed income, forex. So click on the first category, which is equity or stock market analysis, and that will then sort the post by analysis only pertaining to the stock market. Easier way to catch up. You can scroll down. There's videos if you don't have time to watch all the videos or some of the more recent videos. There's some, so most of the other posts will have a one or more static charts, meaning charts you can click and open the image. So that's it. You can go down and catch up that way. Another option is check out our YouTube page. If you hover up here on the menu, there's the Twitter account, Facebook, YouTube. The YouTube account, you click that, it'll bring you to the YouTube page, and you can hover here on this menu and look at playlists. And the playlists are categorized with these different subcategories. Here's stock market analysis. Some of the content is reserved for members only. Or free trial members, you can get in and look at the trading and investment ideas. The ones you'll see on the YouTube page, the more recent ones, anything active right now, meaning there's a trade that I'm still following and tracking and updating, those are blocked. They're hidden. They're not publicly available on the YouTube page. But what I do is after those trades are cleared out, I'll go in and then publish those, so you can go back in hindsight, and you can do that now and look to see how some of these videos have played out before for trading and investment ideas. Stock market analysis, with a few exceptions, some of that is limited for premium members of the site. Most of it's public, like this video today I'll make public. You click on stock market analysis and then you can catch up there on some of the things that have gone on lately. All right, so those are the ways to catch up on the site. So I might briefly touch on a few of the things I've mentioned today. And if I don't, again, a lot more of that's been covered over the last few months, some of the bigger developments in the market that both near-term and short-term things to watch. All right, let's jump back to the chart and let's take a look what happened Friday. Okay, Friday we saw that break of 116, and as I've been harping on for a while, let's just go back to a chart here. This is the 60-minute chart. Of all the major indices out there, the two I follow the most are the S&P 500 or the SPY tracking ETF, or the NASDAQ 100, which has the tracking ETF QQQ. I put the highest weighting in the Qs, although I do watch those two indices closely. Those are your large cap indices. You know, you have the Dow and some others out there. The Dow is only 30 stocks. So I don't really put much emphasis on that. And I always say the mid and the small caps, they'll follow the large caps. The large caps are going to really dictate where the market goes in the longer term. This is a 60-minute chart of the QQQ. I've been putting up really following this 60-minute chart very closely. And the reason being, we've been in this trading range. We had this slow grind, a very tight ascending price channel, and then for about just over a month, we had this sideways trading range here, and that was bounded by 116 on the downside and 118 on the upside. And I've been stating clearly that I favor a break below 116 versus a upside break out of this pattern for all the things, again, mentioned in the recent update, including these divergences that have only continued to build. Yes, I have pointed the divergences out back here. Yes, I pointed them out here, divergent high there. But these divergences were never taken out, nowhere close. In fact, as I made mention in a lot of the recent updates, as these divergences only continued to build, where I was looking for a decent correction here, as the divergences grew larger and the price compression here, this tight trading range occurred or developed, my expectations for an even larger move kind of morphed. That, you know, instead of just a quick pullback trade, now I am looking for a much bigger move. And I can tell you, you know, I won't paint a mixed picture. I'm going to show you some of the bullish scenarios, things that may happen, but Friday's action by all accounts was bearish, and I very much expect more downside. Whether we gap up on Monday, and I'm going to get to those levels, or we have a little upside this week, I would only view that as a great shorting op if we happen to bounce back to 116 or somewhere, you know, maybe slightly above that level. And again, I'll get into that. But as I've stated here, and this again goes back, this chart was from August 31st. Was waiting for a break of 116, watching for a breakdown followed by impulsive selling as a likely catalyst for a move down to the 110.70 level. Now, the key word here is impulsive selling. What does impulsive mean? There's really two things I use to define the word impulsive. Number one, impulsive price action. This is not an impulsive move up from this point to this point. This is impulsive selling. What we did is we gapped down. It doesn't reflect here. You don't see red bars, but this gap, if you really have to look at that, that's a selling. There's where we closed on Thursday. So the candlestick, although it's not going to be reflected on a gap, that's really the move down. So this is the 2.52% drop was from Thursday's close all the way down. And impulsive, if you look at these series of large red candlesticks with just one little green doji in between, and then followed by a big red candlestick in the close, absolutely, this is what the definition of impulsive. And you look at the 60 minutes. See, once we broke down below that 116 level and failed to get back up above it, the very large candlestick, and probably the big, well, other than the one at the close, came right after that. Once traders realized 116 was gone, and at that point, once it was clearly in the rearview mirror, the selling really kicked in and just was relentless throughout the day. It really didn't abate. So the other component to impulsive is the volume. We look at volume here. We go back. We had some impulsive selling back here with high volume, and that turned out to be a selling climax. That came on the end of a downtrend. And selling climaxes often, indicate a lasting bottom, which we had, and we had a rally from there. This is not a selling climax, not in my opinion. Number one, selling climaxes only come after an extended downtrend. So that's first and foremost. That's why they call it a selling climax. This is a breakdown on high volume, impulsive, by a well-watched level, and a breakout of that compression, that price compression, those Bollinger Band pinches that I've talked about. And let's look at that real quick. And forgive me if I touched on this in the beginning of the video. I had this is a second attempt to get this video through. I had went off and I had a chart that was all messed up and wasn't marked up, so I started going through that, and it was taking too much time, so I've started the video over. Again, if you followed the site, you've seen this chart. These are the Bollinger Band widths down here. Bollinger Bands, if you're not familiar, just Google the term and you'll see what they are and how they work. But essentially what happens is they when they compress or they pinch to very tight levels, the Bollinger Band width is measured down here, the distance between the two Bollinger Bands. And as I pointed out, going back for years, this really goes back to 2009. So throughout this bull market, and even beyond, when you have the Bollinger Bands pinched to the level that I put here, this blue line, in every case, without fail, it was followed by not only a large move, but in this case, every move was to the downside. A drop of 8.7%, 4.5, 4.7. Again, I'm just following up where the band's pinched, putting a vertical line to show you where that occurred on price. And then this is the measured drop. These two black bars measure the scope of the drop, 6.3, 9.6. Made notes there that we didn't hit that level, but we stayed at unusually low levels on the Bollinger Bands for an extended period of time, and that resulted in that big move. And this most recent compression started here, only it grew to extremes not even seen throughout this bull market. You can see, if you look closely, that the levels of the Bollinger Bands, the width dropped below that blue line there. So again, everything, this and other things I'd point at, the divergences, which we'll get to in a second, showed that that this is more than likely the beginning of a new downtrend, the way we broke out to the downside with everything else confirming. And on the 1 minute chart, if we look at, again, this is the 60-minute chart, and there's that breakdown, the impulsive selling I talked about. We closed right at these targets, have not changed. I've had this up for weeks, if not months now on the chart, and that's not, in my opinion, it's not coincidence. This is a reaction. We closed right at or just a hair above that level, that 114.12, which was my first support level. It's a minor resistance level. We could have a reaction very well tomorrow, and if we did, I tell you, maybe a reaction up, even halfway up. If you're wanting to get short, I think a bounce anywhere halfway up to the 116 area, all the way up to it, and there's even a gap above. I wouldn't be surprised to see a bounce even to where, you know, we gapped up, opened up, or at least not opened, but the highs on Friday, right around 116.60. Anything above there, I'd hold off. Because if we get into there, we might backfill that gap. Then that brings us all the way back to the midpoint and maybe beyond on that channel. And if that happened, then something else might be going on. I don't see it happening, but if it does, that would raise concern, you know, for the shorts or for the near-term bearish scenario. And then we just kind of sit back and watch, because in that case, the charts are all messed up. I wouldn't go long. I wouldn't become bullish at that point. But I would just say, hey, wait, something's going on here. The charts aren't very clear. So in my opinion, to make it clear, the market has no business bouncing back tomorrow unless it's very fleeting, you know, brief move into that gap much below or much above 116.60. So again, I think anything from, you know, around here is very objective all the way up to there to short or add short exposure if you haven't done so yet. Can you add at this point? Well, possibly. If this 114.12 level goes, you know, I still think at minimum we're heading down to 1075, and again, that's a minimum target. I'll get into that on the longer term scenarios. But as we see here, you know, on Monday, you know, it was some of these big bangs, these big moves, especially drop out of a tight trading range like we had, they often occur on large gaps. Either we could have gapped to the upside above 118 or to the downside well below 116. That often is the case, and that makes it tough for those that aren't already short to get in. Let's say we had gapped down, you know, market closed down 2.5%, which was, you know, you can see if you look at the box in the upper left-hand corner, that shows the move down. But let's say we gap down here, somewhere around here, 2% gap. That's not out of the question. That would make it tough. That would be a hard entry if you weren't already short, because you're so far, it's what I call no man's land, where you're between support and resistance, because the market at that point might have wanted to come back to S116, in which case you'd be giving back immediately about 1% on an index short. It's pretty big. So if you did QID or let's say SQQQ, the 3 times short, well, there's a 3% loss, and that could have happened in a second. That wasn't the case. This was a beautiful entry for those watching 116. You know, we limped down through it. Volume started to pick up a little, but that wasn't much more than those previous breakdowns we had. Remember a couple weeks ago, we had these three little times where you can see just barely those candlestick, those little tails right there where we punched through, but there was no volume, no impulsive selling to confirm it. And it was only by, we're talking pennies on a $116 share price. So just basis points in percentage terms. Those aren't what you short. You wait for the impulsive move. And what happened here, we broke down. We tried to come back up like we did before successfully because those other breakdowns were very brief. And we snapped right back up above 116 and remained up above 116, kept going back up. This time we backtested, failed. Came back up, tried to backtest again, failed, and started rolling over. At that point, we were already down to 115.78. And I think that's pretty safe. You see volume coming in, and anytime throughout the day, you could have just continued to add. And at this point, again, certainly don't want to short at the close while we're down 2.52 at that percent and heading into a weekend. Anything can happen overnight tonight. I'm doing this video. It's Sunday at 1, almost not even 2 o'clock yet, so the futures aren't trading. But I just want to say that, at this point, if you're whatever your position is, long, short, or cash, wait and see what happens tomorrow. But I am going over some levels here that might help. But I just wanted to say this was textbook selling, and you look at the size of that candlestick, and remember that's the big candlestick there, and there's that gap above it. So 2.5, 2.5% drop out of that trading range and well below it is a pretty solid sell signal. All right, now let's look at some near-term targets and levels. Let's go to the NDX, and then I'll look at the SPY, the S&P 500. All right, this is a daily chart. I know there's a lot of lines here, and it can look a little busy. Don't focus on anything in the left or right at this time. Let's look at this box, a shaded box. This is my target zone right here, and this is also an important level. Call it between, let me try to give you this, upper lines at 40, call it 45.90. There's a zone there. There's two lines together, 45.90 and then 45.75 almost. And then this lower level here, about 45.30. This is, I think, an important level. This is my pullback target zone. And the easiest way for me to say this, I don't think if the market is going to new highs from what we've already done, if we're going to go back up, take out those highs and continue on another 5, 10, 15, 20% beyond, I don't believe the market has any business pulling back beyond this level. I already talked about that, some similar levels on the S&P 500. So the bull scenario, and I will tell you now, if I were bullish, which I'm not at this point in time, I'm not foaming at the mouth bearish yet because, again, one day doesn't make a trend, although this certainly has all the makings of the beginning of at least a decent correction. But if you're bullish, I don't see why you wouldn't want to buy long anywhere from the top, maybe scale in all the way down to the bottom of the resistance, that support zone, not adding to it unless we reverse. In other words, I wouldn't keep adding below that. Things, if and when prices start moving below that level, again, that was, I'd have to clear those out to tell you, that was, 45.30. It will really start to roll over some of the trend indicators to intermediate term trend indicators to bearish. We're about to go on to my short-term trend indicators just in one day are close to flipping to bearish. They haven't done so yet. Any more downside? In fact, some have, I should say, some of the quickest, the faster trend indicators, if you will. So that's an ideal level, and I would be surprised after this big red candlestick and everything that's happened, everything else I've talked about, if we don't at least hit that level. And so you're talking then another almost about 2 to 3.25% downside. And again, the bullish scenario will be a reversal off that level and a continued move higher. I don't favor that scenario, but I'm very much open to it, and I will assess the charts if and when we get there. However, the bearish scenario has us going down, breaking down below that level. One possible bullish alternative would be there's this minor downtrend line I drew here. Maybe we have a big flush out move here and then we go down. That's possible. But if we continue lower and start smashing through these levels. These are pretty important support levels I have around 42.85, 41.82, 40.75. I'll cover these on the weekly charts. You'll even see them better. That would be quite bearish. You can see the divergences here on the daily time frame. We had this large divergence. This one nearly as powerful as that other divergence. And look what happened. We had a similar divergent high, and that led to a 20% drop right there in the NDX. I don't see any reason why, especially taking in all the longer term stuff, why we couldn't be looking at a 20% or more drop here. Very possible. We'll have to take it as it comes. Let's look at the near term scenario on the S&P 500. Okay, this is a similar support zone that I have on the S&P 500. I'll draw it out here. It's a shaded box, and just try to quantify it. It runs, this is a horizontal support level around 211.18 down to about 2084. That's where I would expect, if this market is strong and there's a bid beneath, and this is just a little bit of jitters for the upcoming rate hike. I'm sorry, I shouldn't assume rate hike. I think we'll probably get one. But again, it depends what I said. Friday's post, I started composing that long before the market even opened. The futures were doing fine at the time. About the market, it's time for the market to throw a hissy fit. I even started composing that the night before, and before I even looked at the futures, and it just was so late, so I kind of put some notes down and figured I'd start working on it in the morning, which I did, and boom, the timing was spot on. This is a hissy fit. This is what I'm talking about, and this is what the market did before. Every time there were talks that it looked like we might get a rate hike, the market threw a hissy fit, and the Fed cowed down and decided not to raise rates. So that's what's going to happen. Now, let's see. I just suspect, unless they throw a really bad hissy fit, I mean, they throw a tantrum and bring the market down. We've got, what is it? Today is the 11th, so tomorrow will be the 12th. 21st, they come out with the decision. So just another 10 days from now, anything can happen. The harder they take this market down, the less likely the Fed is to raise. But if they don't take it down too much, I think we're going to get that hike. And most traders don't want to be long. Long-term investors know you don't want to be buying into stocks at the beginning of a Fed hike cycle. Now they're going to come out. I guarantee you, if they hike rates, they're going to use some pretty strong verbiage that they don't plan to hike rates anytime soon. They'll want to quell fears. The market will probably kick and scream even after we get a rate cut. Who knows what it'll do? Maybe it'll rally on that, just that we got a quarter point if they give it. Assuming, again, if we get it, we might not get it. Anyways, trade the charts. Trade the charts, not the what you think's going to happen. The charts right now say there's more downside. There's my bullish scenario. You can see this downtrend line here, the blue downtrend line. That's what, if you recall in the other videos that I covered, and this was going back weeks, I said I expected us to come down. I said I expected the markets to, that a lot of eyes would be looking to buy a back test of the 2015 highs. And so market participants might think that we're going to bounce there, but I was very clear that from my experience and my preferred scenario, and I even called it my preferred bullish scenario, would be that we break that level, which we did. As you can see, we closed well below it, the 2015 highs, that first line, and come back down. And the most bullish of my scenarios would have us back test this level here, this downtrend line and or that horizontal. You can see this level here is defined by, I have these reactions. These lines are here for a reason. There's reactions along there, reactions. So this is a horizontal support level, very solid level. And as I said before in the other videos, if the market smashes through this level like it's not even there, I do expect a reaction. A reaction can be a bounce and or a consolidation or a pause. I would at very least expect that. But I would not be surprised to see it smash through the level. Now, if it smashes through that level like it's not even there, I don't think you want to be long. That's not good. If you don't see the buyers step in at that level, because again, if I was longer term bullish, which I'm not right now, that's where I'd be buying for that bullish scenario I talked about. And so if you are, I think it's objective there. You can go ahead and buy, set your stops not too far below, and you can't get burned. Now, if we take that out, these are all support levels. So maybe we go a little farther than, like I said, my most bullish scenario. This would be slightly more bearish, but still longer term bullish. And that's trading 101, folks. These are going to be well watched support levels. There's 2084. Here's a big one down here at 2040. And the way I look at this is, again, of course, if we reverse, or even if we reverse in between any of those levels and start moving up impulsively, then that's certainly bullish. If we take out the highs, then I mean, they can't even take anything from that. Of course, that's bullish. But the way I view it is, if and when or as each support level where the market should reverse gives way, that greatly strengthens the longer term bearish case, because at this point there's a lot of supply here. There's a lot of trades that occurred over the last couple of years as the market was in this large sideways trading range, and there's really no reason the market, after breaking to new highs, should revisit that. We've already failed that new high. This is a bull trap so far. Technically, I don't consider it, because I said, from my experience, these new highs are tested slightly below the previous high level, so I'd almost expect that, like I said, or I did expect it. But from this point, we shouldn't be dropping down to, let's say, 2021. And as each of those levels go, and this is a huge one, that 1992, call it 1990 level, that's probably a lights out level. If the market gets down there and breaks that level, I think the odds at a new bear market underway is very, very good. But one thing at a time. Trend indicators right now, all but the shortest term, are still bullish. So we can't get too bearish over Friday's action. There's a divergent high. It just didn't extend that line. The MACD is still above the zero line. Things I look for. Let's take a look at the weekly charts and we'll wrap this up. Here's a long-term view on the S&P 500. There's a primary trend line off the 2009 lows. Here's another alternative trend line here, both broken. And then this kind of muddled up the charts. We had what seemed to me a nice, clean bull market uptrend lines, all broken. We even had some of my intermediate to longer term trend indicators flip bearish. But this was just a grind, and I can't, nobody won. Bulls or bears, nobody won during this period, because the market now, as I said, we just failed the 2015 highs. That means we've gone nowhere now in over a year. Absolutely nowhere, because those highs came back in May of 2015, and we're already in September of 2016, and we're back below where we were now in May of 2015. So bulls can't declare victory, bears can't. It's been a frustrating market. It's been a trader's market. We've had rips and dips where swing traders can make money. Investors are going nowhere. This is a broadening top pattern right here, an ascending, or just a broadening top pattern, or a megaphone pattern, where at the top of that would be very bearish to see a downside break. And these are key support levels. This orange level here, 1825, that's certainly a lights out level. If we take that out, you can just see those reactions back from, that we had in the meltdown earlier this year, in January and February, that double bottom there, and some reactions back there. That would be, in my opinion, if and when that key support level goes, which I give it decent odds at this point in time. See, the long-standing divergences tell me that trend reversal is still likely. That would be my primary target right there, about 1581 on the S&P 500. But again, that's a little ways off for now. Let me take a look at a couple other charts and we'll wrap this up. Okay, this is the NDX and NASDAQ 100. Again, a busy chart. Don't worry about these trend lines down here. They're older support levels from way back when. That's where they're light in color. This purple line here, magenta, whatever you call it, goes back. The NDX actually, unlike most other U.S. indices, bottomed back in 08. It had made almost an equal bottom in March of 09 when everything else did, but the NDX bottomed slightly before the S&P 500 and most other U.S. indices. And that's where I put this purple trend line. If you look, zoom in, you have a lot of reactions. You have a reaction there, reaction there, reaction there. Breakdown, impulsive breakdown. That looked like the real deal. And then a back test. And it still may be the real deal. In the bigger picture, guys, the bigger picture, this is, 7.5 years, this bull market. And there's a breakdown, a back test, prices rolling over again off the back test. And so far, yes, we made a new high, but it was a marginal new high, and we've already failed the previous highs. And if I was trading a stock, whether it was on the 60-minute or daily time frame, and I saw this same type of action, a rising wedge pattern with a breakdown back test, prices rolling over, one last thrust that might have went slightly above our entry, that doesn't wipe out the bearish scenario at all just because the price has made a new high, especially because it did so. 1, 2, 3, this divergence. This is a weekly chart. Look at this divergence high right here. Negative divergence on that most recent high. You see the PPO rolling over, the MACD. Yes, we had a divergent high here, and we also had a heck of a correction. We had a divergent high here, right here, and we also had a heck of a correction. Now we have a third consecutive but even more powerful divergent high, because this divergence spans all the way back from late 2014 to this point in time, with prices making a series of higher highs, with all the indicators, at least the ones I watch on the weekly, the PPO, the RSI, making lower highs, and both appear to be rolling over. With the PPO, you can see it curling down here. So this certainly opens the door and paints a picture of much lower stock prices, and this is really the lights out level, in my opinion, for the NDX, about 3790, that red line there. There's that low we had from that correction back in 2015. We had that other low back in what was that, February of this year, 2016. We had some reactions back here, reaction high there. So this is a critical support level, and that's a ways away, and you just have to stay open to all possibilities. That's about a 19% drop from where we're at. I was going to get into trend indicators, go over those too. I can just tell you that all the long-term trend indicators right now are still bullish. All but my shortest term trend indicators are bearish. But my trading style, to wrap this up, I'll tell you, unlike a lot of traders, I listen to other analysis out there, whether they're traders, just newsletter writers, folks on CNBC, and one of the common sayings on Wall Street is, "The trend is your friend," and that one just boils my blood, because it's so easy to say that and say, okay, the trend is your friend, but let's say right here at this point in time, let me find a clean board. Okay, so the trend is your friend right here. The trend's been going up for a long time. If you don't pay attention to indicators, see, I anticipate where the market's going. That's why I named the site Right Side of the Chart. I take what I see on the left to try to forecast what will happen on the right side. That's anything beyond where prices are. That's the right side of the chart over here, the future, if you will. And does it work every time? Absolutely not. But I think you can do a pretty good job of. My point being, trend followers are bullish. And at what point do you become bearish? See, most of those trend indicators, and I'm sure you all mine flipped to bearish at that point. So where did they decide that the trend was bearish and to get out of longs or start shorting? Here? No, because we've had a lot of pullbacks along. Was it here? No, it was probably right here. So what they probably did is got blown out of their longs and started shorting there and got caught in a rip, and then decided, did they determine the trend was up after the first day? No, they probably figured it here. In other words, it's easy to say, and sure, the longer term trend, if you're an investor, is still up, and it's not even close to being bearish. But as far as swing trading or really moving around in a tough to navigate market, if you wait for a trend to confirm, in other words, if you wait right now for the long-term trend indicators to confirm, for the folks on CNBC to tell you we're in a bear market, well, you'll be down about another 20%. We only dropped 2.5% yesterday. So again, I don't want to get too excited over it, but I want to wrap this up saying that everything in the charts indicates there's more downside to come, more than likely. And if there's not, we just go back to those 60-minute charts. Again, I told you what will, I should say, obscure the near-term technical picture, and that would be the markets bouncing back, getting above Friday's highs around 116.54. So especially a full backfill of that gap. And without a doubt, anything, the market has no business right now with what happened on Friday getting up and breaking above the 118 level. And if it did, guys, that would be very bullish, because this would be the biggest bear trap we've seen in years. This big breakdown looks like I just went for half an hour talking about how how everything lines up and it looks like the real deal. So should the markets, especially forcefully, come back up through here and break through 118, and I would tell you, don't short. Wait for evidence. I can't tell you what to do, but I tell you I wouldn't be shorting. And in fact, I'd be probably looking to get pretty aggressively long. So there it is. If you guys have any questions, feel free to drop me a line in the trading room or under the comments section on this post. This has been Randy Finney. If you like the video, give it a thumbs up. And otherwise, I'll see you during the week.